Well, the world is freaking out today. And the question is, are we headed for another financial meltdown in the wake of the failure of Silicon Valley Bank? We're going to be talking about that today, along with a few other things today on The Brian Hirsch Show. Well, greetings today, everybody, wherever you may be. Hope this day finds you well. Happy Monday to you. No guest today. The guest we had scheduled came up ill, and so we will have her on hopefully next week. So you just get to spend your day with me today. Hope that doesn't upset you too terribly much. You just get me. But the world is freaking out today in the wake of what's happened over the last 72 hours. I had somebody approached me on the driving range of our country club on Saturday morning asking about the market, about the real estate market. And he asked me specifically about the news about Silicon Valley Bank. So apparently, here's what has happened. There was this, major bank up in the northern part of California that ran into some trouble, and the federal government's having to step in and bail them out. This from Fox News this morning. Joe Biden says Americans should, quote, feel confident in the banking system after the federal response to the SVB collapse. That was this morning at about 9 o'clock. And so it kind of begs the question, what exactly has happened? And what does this mean for you and me? So I am not, of course, a financial expert, but I did do some research on this issue today, and this is what I've discovered. Okay, and perhaps we'll be able to have some people on from the financial markets that can help explain this in the coming weeks. But what you've got is a bank that, and you have the FDIC, right? The Federal Deposit Insurance, right? So this is something that came about during the financial crisis of the 30s under President Franklin Roosevelt, where people would not panic and withdraw all their money out of the financial institutions and cause back then the Great Depression. So it was this idea that the federal government would insure deposits up to $250,000. Okay, so what has happened with Silicon Valley Bank? Well, this is again, as I understand it in my research. What you had happen in 2000, essentially 20 and 21, is the federal government just shoveling trillions and trillions and trillions and trillions and trillions of dollars into the economy. And a lot of that money ended up in tech in a bank like Silicon Valley Bank. Now, when you go put your money in the bank, you make a deposit, they keep a certain amount of it on hand so that when customers go and say I need to withdraw so many thousands of dollars, they have the cash on hand. But most of that money, and this is how banks make money, they lend it out at an interest rate. And among the places that the banks do investing is in the bond market. Now, why is this important? Because in 2020 and 21, where was our interest rates? Well, you got, very low interest rates, and at whatever the prime was back then, let's say it's somewhere around 2 or 3%. And the banks were investing in the bond market. Silicon Valley was investing in the bond market. And the challenge to that is what they did not take into consideration is that they were investing in the bond market at a very low rate, and that there would be a run up of interest rates, as we've seen, where now the bonds are much more expensive. Well, this isn't an issue unless you have a situation that's happened this past week where there is a run on the bank, meaning that a disproportionate or a larger number of people come and make withdrawals from the bank than the bank has on hand in cash to satisfy those people who are making those withdrawals. And so then they have to sell off their bonds, and they're selling them at a much lower rate than what the current market is. So they're selling the bonds at a loss. And enough of this happens, now all of a sudden the bank goes bankrupt, which is what happened with the Silicon Valley Bank. So what the federal government is doing is saying, we're going to come in and we're not going to bail out the bank, but we're going to bail out the banker or the depositors. So if you've put your money in that bank, the federal government is saying, we're going to make sure that you can get your money back. But they're not at this point guaranteeing that the bank itself will survive. Now, the issue that we have with this is if it's just one bank, probably not going to be that big of a deal. But if it's a lot of banks, and it's a lot of banks that are quote unquote too big to fail. So if you remember this from 2008, we had all of these big banks, Bank of America, Merrill Lynch, all these huge financial institutions that the federal government, if you've never seen the movie The Big Short, it's a little tough to follow, but it does help get your mind wrapped around how all of this went down, where the chief economists for the Obama administration were telling him, look, you either bail these banks out or the whole system's going to collapse. It does not appear at this juncture that that's what we're facing. And again, what was interesting about that is the bad investments were in these mortgage-backed securities full of bad mortgages. So it doesn't appear at this juncture that that's what's happening with the Silicon Valley Bank, but it is an indication of how delicate sometimes our economic system can be. I'm personally surprised the current administration, the policies of the current administration, first and foremost, with more or less sabotaging the oil and gas industry, our fossil fuel industry, and just immediately upon being inaugurated, President Joe Biden ceased drilling, withdrew leases on domestic land, some of our offshore, shut down the Keystone Pipeline, and these things that diminished our capacity as a country to generate the supply for oil and gas and made us more and more dependent on foreign oil and gas. And that constriction of supply, coupled with even just a normal demand, caused the price of fuel to skyrocket. Everybody's seen it, right? You've seen it at the gas pump. You've seen it with your heating, or your heating bills to heat your house. I've heard some people, their gas bills have gone up by 50, 60, 70%. Well, coupled with that and this financial policy, this in and of itself, there's other things, but this is the starting place. The cost of business for everybody got more expensive, for restaurants, for grocery stores, for retail chains, for uh, people even supplying goods and services in the marketplace, like internet providers and so on and so forth. The cost of business went higher. The other piece of cost of business that went dramatically higher was labor. You had a period of time during COVID where the government was paying people not to work. When that benefit, if you will, fueled by the government just shoveling tons of money into the marketplace, went away, and it came time for businesses to reopen. It came time for people to go back to work. All of a sudden, the labor market responded by saying, gosh, I don't think I'm going to want to work for $10 an hour. Maybe I want to work for $15 or $18 or $20. Here in California, our minimum wage is $15, but you'll be hard pressed to find any business employing even their entry level laborers at the minimum wage. It is 18, 19, $20 an hour. So for those businesses, all of a sudden that line item on their P&L every month, labor, which is always the biggest one, that's always the largest line item for a business is labor. And that goes up by 50%, coupled with now it costs more for them to do business because of the higher price of fuel. This caused inflation, rampant inflation, along with the devaluing of currency by pumping tons of it into the marketplace. And we've all felt this. So when you have a market condition as such, how is the government going to respond to that? Well, the federal government, the Federal Reserve, they get together, and I think their next time they're going to meet is next week, if I'm not mistaken. And they make these announcements about raising the cost of doing business on the banks. So and I'm going to again want to have one of our financial experts on to be able to explain this better. But if the federal backed system is charging the banks more money to lend them money to back their loans, and it was say 2 or 3%, and now it's gone up to 5, 6, 7%. The banks then in turn will pass that expense onto the consumer and charge them more money to borrow. And this is, of course, how it impacts us in the housing industry, that mortgages go up. And all of this is connected to the bond market. So where, as I see it, as I understand it, Silicon Valley Bank made an error is how much they were vested in the bond market at a lower rate, did not see all of this tons of money being pumped into the marketplace. That coupled with all of the businesses at the higher cost of doing business, the interest rates going up, up, and up. And if there's a run on the bank and people make withdrawals outpacing what you have on hand, and you have to sell off your investments in the bond market at a lower rate at a loss, you have a recipe for disaster. And this is what has happened with Silicon Valley Bank. So for us, I think what this means is it is something for us to keep an eye on. For sure. But the answer to the question, are we headed for a financial meltdown if the crisis is limited to these two banks? I think there was maybe 2 or 3 more banks that are having this issue. Then we're probably going to recover okay. And if the situation is more widespread, it could be, a problem for our economy, and it's certainly something for us to keep an eye on in the weeks to come. So, with that, let's move on to the update on today. As of today, the housing market in the high desert. Now, what we're seeing in this graph that I have in front of you, for those of you who are listening on the podcast, I'll read to you what the live stream audience is seeing. But this is emblematic of what's happening in our nationwide market. So I follow some trends on what's going on, and it seems that everyone is kind of saying the same thing, that what we're seeing is an unprecedented market. This is kind of what we talked about with Mike Arias, a very low demand, or lower demand than perhaps usual, and coupled with very low supply. So you have offsetting factors. So for those of you who have asked me, is the higher interest rate going to lower prices? The answer to that question is probably not more than we've already seen because interest rates were kind of at their peak in November and have come down since then. So they've kind of been bumping down and then come up and up and down. So this is one of the reasons why we're giving you this weekly market update. So for those of you who are on the fence of buying a house, kind of hoping for either the prices to come down or the rates to come down, probably not going to happen. Historically, interest rates, if you look at, the last 75 years for a mortgage, have always been around 6 or 7%. So the issue is, do our home prices support that interest rate? Well, it's kind of like if I'm driving in the street and I say, "Oh my goodness, gas is $5.50 and the market can't support that price." The market will support a price of $3.50. But the thing is that if gas is $5.50, we kind of don't have a choice, do we? And so one of the things I look at also is what people are paying in rent. If you see the rents come down dramatically because of an abundance of supply come to the market, and people can find a decent house, here in the desert that people would like to pay somewhere between $1,000 or $1,500 a month in rent, but you're going to be hard pressed to find anything for less than $2,000 in rent, and probably to find something decent is closer to 2,500. And then you start having to ask the question, is it really worth it for me to just pay $2,500? And that would be what, somewhere in the neighborhood of 25,000 less another, yeah, somewhere around 30 grand a year in rent, where I could be leveraging that money into a mortgage. And even if the payment were higher, or $3,000 a month for my mortgage, that extra $500 a month is kind of the investment into myself and reducing a principal balance and actually owning the asset. And this is a market condition that we're seeing across the board, the offsetting factors. The high rate is curtailing the run up that we saw in the last 3 years in pricing, but it is offset by the low inventory, which is causing the pricing to kind of remain stable. So let's look at it. This is March 13th. The last 30 days sold 285 homes. That's up a little bit since last week. Our median sale price for those 30 days, $399,000. Now, if you take those two pieces of data, we had 285 homes sold in the last 30 days at a median sale price of $399,000. How does that look year over year? And this is where we have a very fascinating piece of information, because rates 1 year ago in March, the second week of March 2022, we were hovering around a 4% interest rate. So if you kind of juxtapose the same period year over year to take a look at what the market's doing, this is fascinating. Remember the affordability factor. It was a lot more affordable a year ago. And yet, 1 year ago during the same period, this would be February 13th to March 13th, our market, and again, this is Victorville, Apple Valley, Hesperia, Adelanto, Phelan, and Oak Hills. Our market moved 269 homes. And so year over year, we've sold 5.9, call it 6% more homes during the same period than we did a year ago when the homes were more affordable. And this is one of the things that raises an eyebrow for me on what the market is doing. A year ago, our median sale price during that same period of time was 415,500 homes. Again, the homes were more affordable. So we're down about 4% on our median sale price, all the while we are up about 2% or so in our interest rates. So the number of homes sold and the median sale price is very resilient, even in the face of higher interest rates. And what is causing this, of course, is this constriction of supply. In escrow, right now, we have 485 homes in escrow. So we're up 4% since last week. We have 4% more homes in escrow than we did 1 week ago. Now, what happened yesterday? Daylight savings time. Now, all of a sudden, instead of having an hour of daylight in the morning, we have that hour of daylight in the evening. It was getting dark around 6 o'clock. Now it's getting dark around 7 o'clock. What does this mean for the consumer? It means that during the weekday, Monday through Friday, when people get off work, 3, 4, 5 o'clock, they still have an hour or two in the evenings to go out house hunting. That's when all of a sudden, I've got buyers I'm working with. I say, what days and times work best for you to go look at homes? They'll often tell me weekdays after 5 o'clock and Saturdays and Sundays, all day, morning or afternoon. Now, all of a sudden, the frequency of showing schedules and the appointments made to get out with the buyers and look at homes increases. So you have more activity. Couple that with what else is happening this time of year? People are filing their tax returns. And what do they get oftentimes, especially first time buyers? They're getting money back. So you're going to see more and more activity happen in the marketplace and more homes go into escrow. This is what we're seeing. And at the same time, how many homes do we have listed on the market? Well, last week it was 780. Today it's 773. And again, what we'd like to see is 15, 8, we literally like twice the number or 2.5 times more homes, somewhere between 1,500 and 2,000 homes on the market would make for a plenteous supply where the shelves are full and the buyers have plenty of options and they can choose neighborhood and they can choose square footage. Right now, it is a very tight market. We're down essentially 1% since last week. This is something really to keep our eyes on. And so for those of you who are thinking of selling your home, this is likely to be a good window of opportunity the next, 30 days or so to get your house listed while it seems to be that the buyers have responded first. The buyers have come to market first because they need a place to live. And so now Mrs. Seller, maybe now's a good time when you have less competition with other sellers to capture those buyers that are now coming into the marketplace. And update real quickly on our current interest rates. This is from Samantha Zumwalt at PRMG. Shout out to you, Samantha. Thank you for providing the information. Ranging between 5.625% and 7.25%. This is again for FHA 30-year fixed with a 660 FICO score. Okay, so what does this mean for us, guys? Well, as far as the housing market goes, it remains steady. And what's interesting is in the wake of the financial meltdown, there was an increase of activity in the bond market, more money going to the bond market, which rallied the market and softened our mortgage rates this week, or at least for today. So if you're thinking about buying a house, let's get you in touch with Samantha or Pride, my other preferred lender. Let's get you pre-qualified, get you out there looking for a house. All right. So now let's move on to the segment of our show that we call Check This Out. And I want to recommend to you a book that I read, gosh, it's been over 20 years ago, by John Maxwell, called The 21 Irrefutable Laws of Leadership. And currently, we are taking our leadership team at my church through the 21 laws. I mentioned that last week with Coach Artie Allen. And in rereading the book, there's timeless information. They did have a 25-year anniversary edition with some updates to it. And I highly recommend it. But I wanted to share with you specifically, it was chapter 3, the law of process. And some of the things that were said. One of them is if you are persistent, you will get it, meaning whatever the goals or whatever you're striving for. And that momentum is the result of many pushes, not just one. If you are consistent, you will keep it. Excellence is a result of many practices, not just one. And this was, you guys, the takeaway that I just circled and thought, my goodness, here it is. The right thing to do and the hard thing to do are usually the same thing. And so, for those of you who knew my dad, he left with me a legacy, kind of the Hearst family motto. And it is comprised of 3 values. Number 1, do the right thing. And I would just add an appendage there, even when it's hard. Do the right thing, even when it's hard. Number 2, always do your best. Always do your best. And number 3, treat others the way you would like to be treated. So the right thing to do and the hard thing to do are usually the same thing, but the results of doing the right thing with consistency in your life result in good fruit. Whereas often doing the easy thing, which is often the wrong thing, over time consistently will result in bad fruit. Hey guys, like, share, and subscribe to the show. This is what helps us. Thank you so much for joining us today on the Brian Hirsch Show. Be looking forward to you next week. In the meanwhile, we're serving your dreams.